good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at financial results once again. Finally, our full year results would have come out for Prestige Holdings and WCO, or West Indian Tobacco Company Limited. Let's take a look at how both companies would have fared, and they did in fact fare quite differently for their most recently concluded fiscal years, and what investors might expect in the coming months ahead. Turning firstly to Prestige Holdings Limited, and for their fiscal period ended 2022, the group would have reported a diluted earnings per share of 57 cents per share, which was a very impressive turnaround from the 45 cents loss reported in the prior comparable period. Now, driving this performance was an increase in total revenue of around 55%, from $712 million to just over $1.1 billion for that full year, translating into an operating profit of $72.5 million compared to a $12.2 million operating loss in fiscal 2021. Overall profits attributable to owners of the company would have increased or swung from a loss of $28.3 million to a profit of $35.5 million for that most recently concluded fiscal year. Now, the revenue story was indeed a positive one for Prestige Holdings Limited, as several years, or 2 years in particular, declining earnings or revenues rather, would have turned around into a fairly significant revenue gain over fiscal 2022, moving back to pre-pandemic levels with that 55% odd turnaround. And that was to be expected, given that in fiscal 2020 and fiscal 2021, there were multiple weeks of enforced closures due to COVID restrictions for Prestige Holdings Limited's various restaurants. In terms of margins, well, Prestige continues to be a pretty decent operator, with maintaining very solid gross profit margins there at 32.6% for that most recently concluded fiscal 2022, pretty much in line with its prior comparable years. And those operating and profit before tax margins would have turned around fairly significantly, given that they would have had the benefit of full run times over the course of fiscal 2022 compared to 2020 and 2021. So certainly good news for Prestige Holdings shareholders. At a price of $7.49. The stock is trading at a price earnings ratio of 13.2 times, up slightly above the sector average of 11.5 times, but offering a fairly robust dividend yield of 4.3% on a trailing 12-month basis, relative to that sector average of 3.2%. So with increased economic activity in mind, improving operating margins, balanced by that increased living costs, of course, and higher input costs into the cost of sales, Bourse is going to maintain a market weight rating on Prestige Holdings Limited for the time being. Turning quickly to West Indian Tobacco, or WCO, the group would have reported an earnings per share figure of $1.04 per share, which is a decline of around 30.7% from the $1.50 recorded in the prior comparable period. Now, underlining or attributable to this decline was a decrease in revenue of about 15%, from $850 odd million to just about $724 million, leading to overall profits for the period declining to $261 million for that full year 2022, a 31% decline relative to the $379 million in profit recorded in that prior period of fiscal 2021. Now, for WCO, unlike Prestige, they have not been able to turn around those continuing revenue challenges. In fact, that trend seems to be fairly well set and actually accelerated in fiscal 2022 compared to the prior comparable periods, where we can see that from a high of $955 odd million in fiscal 2019, revenues would have sunk to just about $724 million in the most recently concluded fiscal period. So that's that 15% odd decline. When we take a look at WCO's margins as well, we can see that there was a sharper than usual decline over the past couple of years in terms of all of their margins, their profitability margins, be it gross profit, operating, or profit after tax margins. Gross profit margins, for example, fell to just under 69%, whereas it would have been hovering between that 75 to 77% range in prior comparable periods. And that profit after tax margin also declined sharply to 36.1%, whereas it would have been hovering within that 43 to 45% range in prior comparable periods. Now, all that would translate into lower dividends, so what has traditionally been viewed as a dividend-paying stock for WCO. And as we can see in that light blue segment, dividends per share have fallen 30-odd percent or 31-odd% from that $1.42 in fiscal 2021 to 98 cents in fiscal 2022, commensurate with that decline in earnings, of course, with earnings per share falling from $1.50 to $1.04, and maintaining a relatively stable payout ratio at around that 94% level for fiscal 2022. So at a price of $16.51, now that stock price would have adjusted fairly significantly on a year-to-date basis and over the past 2 years, in fact, to reflect those lower earnings and lower dividends. WCO is trading at a price-to-earnings ratio of 15.9 times currently, which is below the sector average of 17.2 times, and offers investors a dividend yield of just under 6% at these current prices, which compared to the regular dividends of the sector average of 2.8% is relatively attractive. Again, take that with a pinch of salt. There would have been some significant price corrections for WCO over the past couple of years as well. So with those revenue challenges in mind, keeping an eye on narrowing margins, which are expected to stabilize in the coming periods, but of course, looking at that attractive dividend yield and relatively attractive valuations relative to the sector average, Bourse is going to maintain a market weight rating for the time being on WCO. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse. Email us at invest@boursefinancial.com, or you can check out our website where all of our research is absolutely free at bourseinvestment.com. Well, that's it for this week's edition. Stay safe, have a productive and rewarding investment week, and we'll see you next time on the Bourse Report.